Okay, remember I shared with you the Bible, the investor's Bible, the things to do to make sure that you have success with investing. This video is basically, we're going to go over the 10 mistakes I see most investors make. There is a great book that you can read that's a resource. I keep talking about it throughout this course, The Five Mistakes Every Investor Makes. It's a great book. It's one of my favorites, but I wanted to add more in there and to go over some really simple things to avoid so that you have just clear knowledge. You know, you can always come back and refer to this if you feel like you're starting to like slip or something, you can come back to this and you can see, am I doing these things? So the first one is failing to have a clear plan. Now, for the investor Bible that I gave you, it was to have a plan and stick to the plan. So if you don't have a clear plan for yourself, you're probably going to make impulse decisions. You're probably going to like not really understand yourself fully in terms of like your risk tolerance. And then you may end up, picking funds that don't match your particular risk tolerance. They may be a little bit too volatile for you, and then you may feel too nervous about this whole thing. So definitely have a plan. Go back to that, at the beginning of the course and really set up for yourself a clear plan for yourself that you can stick with, something that feels good for you, not what your parents say, not what your friends say, not what the investing world, says to do. Not even me, right? Make sure you create a plan for yourself and that this feels good for you. The second mistake I would say is the biggie, and it's trying to time the market. I see so many people trying to time it. They're in their ego and they think they can beat it, or they they let their fears get the best of them. And I'm going to go over that as one of the mistakes. But people who are trying to time the market often leads to missed opportunities. It often leads to you not being consistent also. So, again, one of the things we talk about in this course is to be getting in monthly if you can, to automate that if you can. That goes completely against this trying to time the market. Okay, so that is a biggie. That's a big one. The third one is lack of diversification. So, really, when you get into an index fund, you're automatically diversifying yourself. That's the beauty and the ease in getting into an index fund. Now, if you choose to start doing stocks, then be very careful about not just putting, you know, everything into one stock. I've also seen people do that, and I'm just like, how can you do that? I know a woman who her grandma was buying her Apple stock for the longest time. She's kept adding to it. It's the only thing that she has. That's it. Now, Apple's done well over the years. She's done pretty well, but what if something happens to that company? That's it. That's it, right? So diversifying gives you the ability to access many different categories, many different industries, even different regions. So really allow yourself to be open to putting things into, say an index fund or something, multiple things so that you are covered and you're diversified. The fourth thing is chasing past performance. A lot of people will try to base their decisions just on, say, the high returns from the past, and it's really no guarantee. of your success. I mean, we talk about looking at charts and, seeing things performing. But what we're looking at is long term. Okay. If you're looking at short bite-sized clips, like 1 day or 5 day or a month, charts, that you're getting into almost trying to predict what's going to happen. And it's a little bit more like gambling. Okay, so we don't want to do that. We want to focus on the long term, and the potential that's there long term, as well as adding in fundamentals, knowing about these funds, knowing about these different companies if you're getting into stocks. The fifth thing is ignoring fees and the cost that's involved. So we went over this, when you're looking at, let's say, a fund and you're evaluating that fund, or even for a stock, we want to look at the fees involved, the expense ratio for the funds in particular, that can eat away at your potential for growth. So you want to be looking at that and also considering costs. So, if you're trading or starting to invest in some stocks and you want to do that long term, be considering the cost that's involved with that. The more you trade, the higher the cost is going to be because you're trading in and out. So again, there may be a benefit to just keeping some things in long term and avoiding those costs. The sixth thing is letting emotions drive your decisions. So again, if you're in a place of fear when the market is moving, it's going to sometimes get the best of you, and you don't want to let that have make your decision. You want to be in a calm place when you're making your decisions. Also, greed. Like if you're in a place of like, I need this to happen right now, and that's driving, your decisions about you need to buy in and sell, and, that's not going to your plan. That's not sticking to your plan. So you want to avoid being in emotions as much as possible. And remember, some of that can come from looking at the news. It could be from, the market going into dips. It could be from your own fears around, that you have a loan outstanding. Something like that can get the best of you. So really remember to check in and come at it from more like running your numbers and looking at data and looking at charts and looking at the fundamentals rather than basing your decisions off of your emotions. Okay, the seventh one is not reinvesting your dividends. Remember, you always have the opportunity to reinvest your earnings and your dividends, and that's just a very simple setting in your account. So if you haven't done that, please go back and do that. Every little bit matters. If you're able to reinvest your dividends, it goes right back into your account. It gets reinvested and your money can compound. So that's a very simple one, but I don't want you to overlook it. Okay, the eighth one is overlooking fundamentals. So really, this is, kind of like turning a blind eye to things like very simple things that are easy to find online just by using Yahoo Finance, a simple free app. You can go in and research a company's fundamentals. You can find out about their profit margins. You can look at their debt. You can see the news about them. So if you don't look at those things, it's a little bit kind of like you're doing, like this to whatever the company may be potentially making decisions about. And We don't want to do that. You want to educate yourself as much as possible. Now, doing that with your index funds, again, you can go in and you can see what the advisors are up to, what they're doing, and you can look into the different stocks that they've chosen for those index funds, and you can do some research and dig into each of those stocks. So you always have that available to you. We don't want to overlook that. All right, the ninth one is not monitoring your portfolio. So for a lot of people, the set it and forget it is like the best thing ever with index funds. You can basically put them in, automate everything, and then just, you know, completely go about your work, your days, and all of that, which makes it really nice. But we want to periodically look into our funds. We do want to go in and assess and see how things are going. So I would say try to at least do that quarterly, or every 6 months if you can go in and look and see how things are going, right? For your different funds that you've chosen. Are some doing better than others? Then you may want to start allocating more of your funds, more of your contributions towards the fund that's doing better. So that's something to note. You don't want to completely, again, don't have a blind eye to your portfolio. You want to be actively looking at it. And I believe the more that you look at these things, the more you're going to learn. That's for me been, I would say, the biggest thing for me to really, for my success was for me to start looking at charts almost daily. I just do a quick look at my Yahoo Finance app, see where the S&P 500 index is, and then look into my Vanguard account and go, oh, that's where my account is today. And for me to do that, it's basically like helping me to monitor things and get a feel for, is this working? Is there anything I need to change? Is there anything I need to ask questions about? So definitely be taking an active role and monitor your portfolio. And I would say the 10th one is starting too late. You don't want to delay this. You don't want to let your fears get the best of you. You have the best years. The earlier you can do this, the better. So if you can get in sooner, you're allowing for that compounding to work its magic for you. So start as early as possible, even if it's a small amount, like I said, and you'll be able to get your account growing. All right. So really just keep these things in mind. I would say try to avoid them as much as possible. And you have this education. So as long as you're staying disciplined, you're keeping things diversified, and you're focusing on your goals, then you're going to have success with your investments. All right. Thanks so much for watching this video, and I'll see you in the next one.